Hello traders, this is Rich Derrick from Tradesight. Just wanted to check in and talk about the video that we did on November 15th when we were anticipating some sort of a reversal in the market that was really implied by the very negative investor sentiment numbers. That candle in that video was done at this candle here on November 15th, which was the low close of this swing low so far. What I want to do is just take a moment and talk about the overall design of the chart here. We had this pretty impulsive move to the upside. We found the top up in this area, and we got the seeker exhaustion signal up here at range high. That's the 13 with a red arrow above it. This was giving us a warning that the construction was starting to weaken, in that we should be looking for an exhaustion reversal to the downside based on time and price. We leveled off sideways here for a bit, and then we did start to head down and ultimately start to break a little bit more aggressively to the downside. But all the while that we were doing that, the investor sentiment had gone from neutral to extremely bearish in a very short amount of time. And that's what we really talked about in the last video on November 14th when we were talking about this condition in the market. Now here's a look at the most recent sentiment figures that came out this week, and you can see that the bulls jumped by a full 5 percentage points to get up to about 41% again, and they're actually outnumbering the bears now. The bears are down below that 40% threshold. We were up to almost 50% 2 weeks ago. Bears dropped by another 6 full percent this week, which is a lot. Another thing that's a little bit unusual is the velocity with which they're going from bullish to bearish. A lot of times what will happen is you wind up in the bullish camp here, then you go to neutral, and then you go to bearish. But what we've seen in the last few readings from the sentiment survey is how quickly they're going just from bullish to bearish or bearish to bullish. So it's very very volatile, and that's, I think, one of the reasons that we've had this very quick rebound in the market back to the upside here. So let's change the chart back and look at the near-term technicals. Okay, so again, we're back to the S&P futures to take a look at the design of the market. Here was that swing low that we were prepared for off of the investor sentiment results when they got very bearish, which is the contra indicator. So we're looking for a move back to the upside. We had this breakaway gap to the upside here, then we pushed a little bit higher throughout that week, and then we've basically kind of been going sideways until we jumped up again late this week here. But in doing so, we've actually completed a 9-bar setup here. This candle's going to close today. It's 4 o'clock now as we speak, and we're going to wind up printing the 9 here to lock in that 1 through 9 setup phase. And the key thing I want to point out here is that bar 8 here is above both 6 and 7, if you can see, which means that we've got some decent expansion to the upside here, some decent range to the upside here in this setup phase. So what that implies is that we're probably at best just going to stop here and go a little bit more sideways next week, or perhaps even retrace. So I've slid the chart over here just a little bit just to take a look at the Murray math levels, and we've been basing below this 7/8 level, have not been able to challenge it. If we do pivot to the upside and do continue higher, definitely keep an eye on that 8/8 level at 1437.50. That's going to be a very big level. It was also, if you look back here to the left on the chart, it was also the heart of the trading range for all of these months back in here. So it was a very well traded area, and I would expect that traders are going to trade it pretty well again the next time it's back up into that range. Another level to keep in mind, while it's not shown on this chart, I was trying to keep it as clean as possible, but is the 50 DMA. The two biggest moving averages that most of the institutions look at, and that they kind of build together, and that they work off of, are the 200 and the 50 simple period moving averages. Now right now the 50 DMA, the simple moving average, is coming in at 1416.50, and that's the high of both these candles here. They've tested it quite a few times, have not been able to penetrate that. So key near-term overhead of 14.1650, 14.2188 next on the upside, and then 14.3750 up here at the 8 ace level if they can punch through higher. To the downside, this 4 ace level here, 1375, is going to be a very, very big level. It was also the area in which the market gapped to and found support and was able to hold this gap open in here. So a couple things to keep in mind and to be looking for next week. This is Rich Derrick for Tradesight. Hope to see you soon.